Right, imagine you've worked hard for years, saved up a decent chunk of money, and then one morning you decide to put absolutely all of it, every single penny, into one company, just one. Because you've done your research, you believe in it, and frankly you're feeling pretty confident. And then that company goes under. Not a bad quarter, not a dip, gone. Administrators, kaput. Everything gone. Now, I'd love to tell you this is some far-fetched hypothetical. It is not. This happened to real people repeatedly throughout the entire history of financial market. Enron employees who had their entire retirement savings in Enron stock, people who put everything into individual crypto coins that went to zero, people who, bless them, went all in on a single sector at exactly the wrong time and spent the next decade wondering where it all went. The single most effective defense against any of this is something called diversification. And it is genuinely one of the most important concepts in investing and one of the least excitingly named, which might be why people don't talk about this one enough. Today we're going to fix that. Let's go. I'm Leo. Welcome back to Financially Fit Millennial, the channel where we make this stuff simple, honest, and at least marginally more entertaining than staring at a spreadsheet. If you're new here, welcome. If you've been here a while, you're clearly a person of excellent taste and questionable amounts of free time. So today, diversification. What it actually is, why it works, how much you actually need, and the mistakes people make when they think they're diversified, but they're absolutely not, which is more people than you think. Let's get into it. Okay, let's start with the basics, because I want to make sure we're all starting from the same place before I start throwing any sort of numbers at you. Diversification is the practice of spreading your investments across different things, different companies, different industries, different countries, different asset types, so that if one of them has a terrible time, it doesn't drag your entire portfolio into the abyss with it. The classic way of explaining this is the eggs and basket thing. You don't put all your eggs in one basket. If you drop the basket, you lose all of them. Spread them across several baskets, and if you drop one, you still got most of your eggs. I know, groundbreaking stuff. Bear with me. Here's a slightly better analogy. Imagine you own a food stall at a market and you only sell ice cream. When it's sunny, you're doing brilliant. When it rains, you sell nothing. You're completely at the mercy of the weather, which, if you're in England, means you're probably doing badly. Now imagine you also sell hot soup. When it's sunny, soup sales are a bit slow. When it rains, soup is flying out the door. Your overall income is now considerably more stable because your two products perform differently under different conditions. One picks up the slack when the other struggles. That's diversification. Not just owning multiple things, but owning things that behave differently from each other. The last bit's important, and we'll come back to that later. The financial term for how much two investments move together is called correlation. Highly correlated investments tend to go up and down at the same time. You want a mix of things that aren't highly correlated, so that when one zigs, the other one zags, or at least doesn't zig quite as hard. Right, so what can you actually diversify across? Because different things isn't particularly helpful on its own. Let me walk you through the main building block, what we call asset classes, because this is the foundation of any properly diversified portfolio. Shares or equities. You buy a tiny piece of a company. If the company does well, your slice is worth more. If it doesn't, you know. Shares historically offer the highest long-term returns of any major asset class. They also come with the most volatility. They go up sharply, they go down sharply, and they require you to have either a long-term horizon or a strong stomach, ideally both. Bonds or fixed interest. You're essentially lending money to a government or a company, and they pay you a fixed rate of interest in return. Much less exciting than shares, which in the context of investing is a complement. Bonds tend to be more stable, generate steady income, and often hold their value or even go up when shares are falling. They're the soup to your ice cream. Property or real estate, either owning physical property, which most people are familiar with, or investing in a REIT, real estate investment trust, which are basically funds that own property on your behalf and are far less hassle than being someone's landlord. Property tends to provide income through rent and long-term capital growth, and it doesn't often move in perfect sync with the stock market, which is the point. Cash and cash equivalent. Savings account, money market funds, term deposit. Not very exciting, but not supposed to be. Cash provides stability and liquidity, meaning you can actually access it quickly, which matters when life throws something unexpected at you. The downside is that over the long term, inflation quietly eats away at purchasing power of cash. So while cash has its place, it's not where you want everything to live. Alternative assets. Commodities, gold, infrastructure, hedge funds, and yes, cryptocurrency sit here for most people. Though quite where it sits within a portfolio is a debate that I suspect will be ongoing for some time. These can add another layer of diversification because they often march to a slightly different beat to the traditional asset classes. Gold, for example, has historically held up reasonably well during stock market crashes because investors tend to pile into it when they're scared, which is very human when you think about it. The world might be ending, but at least my gold's fine. Right, so that's diversification across asset classes. There's another dimension to this that a lot of people completely miss, and it's probably the one I see overlooked the most. Geographic diversification, spreading your investments not just across different types of assets, but across different countries and regions. There's a very human tendency, and it has an actual name, and it's called home country buyer, to invest heavily in the country you live in because it feels familiar. You know the companies, you've heard of them, you trust them more, it just feels right. Here's the problem with that. No single country's economy performs brilliantly all the time. The UK had a pretty rough decade post-Brexit and post-COVID in terms of stock market performance relative to global market. The US has been extraordinary for the past 15 years, but that doesn't mean it will be for the next 15. Japan had a stock market that went sideways for 30 years. Imagine buying in 1989 and spending 3 decades waiting to break even. That's not ideal. If you had all of your money in Japanese stocks during that period, you'd have had an extremely long wait. If you'd had a globally diversified portfolio, Japan would have been one piece of a much larger picture, and the overall impact would have been significantly less devastating. A globally diversified portfolio, think a world index fund that holds thousands of companies across dozens of countries, automatically adjusts its weightings as different markets grow and shrink. You're not betting on one country, you own a slice of the entire global economy, which feels considerably less stressful. For what it's worth, the US currently makes up about 65% of most global indices because US companies are the largest in the world by market cap. You're just not putting all of your eggs in one basket. We did the eggs analogy already. You know where I'm going with that. Now, if diversification is good, is more diversification always better? Should you just own everything? Every stock, every bond, every country, every asset class? Is that the move? And the answer to that is sort of no. There is such a thing as too much diversification. Peter Lynch, one of the most successful fund managers in history, actually coined a term for it, diversification. Here's what he meant. At some point, adding more holdings to a portfolio stops reducing your risk meaningfully and starts diluting your returns. If you own 500 individual stocks and one of them goes to zero, you barely notice. But if you own 500 stocks just for the sake of it, many of them low quality, many of them overlapping, you've created a portfolio that's so spread out, it can't really outperform anything. You've hedged away all your upside along with your downside. There's also the slightly more mundane problem of just owning too many things to keep track of. I once met someone who had investments spread across 11 different platforms because they signed up for every new app that launched a free share promotion. They had no idea what they owned collectively, whether it made sense together or how it was actually performing overall. They diversified themselves into complete confusion. 11 might be an overstatement, but you get the picture. The sweet spot for most individual investors is somewhere between 20 and 30 individual holdings if you're picking stocks. Enough that no single company can wipe you out, not so many that you've lost all coherence. But honestly, for most people, the easiest and most effective form of diversification is just owning 1 or 2 broad index funds. A global equity index, for example, holds thousands of companies across dozens of countries. You're automatically diversified across companies, sectors, and geographies in one single purchase. Job done. No spreadsheet required, which is quite frankly the dream. Okay, now for my favorite bit, because there's a version of diversification that looks like diversification, feels like diversification, and technically involves owning multiple things, but is absolutely not diversification. And people fall for this constantly. Mistake 1, owning lots of things in the same sector. Imagine you buy shares in Apple, Microsoft, Google, Meta, Nvidia, and Amazon. 6 companies, 6 different tickers. You're diversified, right? You're not diversified. You own 6 of the largest technology companies in the world. They're all in the same sector. They're all subject to the same risk. Regulatory pressure on big tech, interest rate sensitivity, AI disruption, whatever. And they all tend to move in roughly the same direction at the same time. When the tech sector's had a bad year, all 6 of your holdings have had a bad year simultaneously, period. You just bought the same bet 6 times with extra steps. Mistake 2, crypto diversification. This one. The number of times I've heard someone say, yeah, I'm diversified. I've got Bitcoin, Ethereum, Solana, and a few other coins. Genuinely appreciate the effort. However, crypto assets are currently very highly correlated with each other. When Bitcoin has a bad day, the rest of the market tends to have a bad day too. Owning 10 different cryptocurrencies does not protect you from a crypto market crash in the way that owning crypto and bonds and property and shares would. It just means you've got 10 things all falling at the same time instead of one, which is slightly worse, if anything, because at least with one, you only have to watch one number go down. Mistake 3, funds that overlap massively. This one is more more subtle and catches a lot of people out. Someone buys an S&P 500 index fund, then they buy a US large cap growth fund, then they buy the NASDAQ 100. They think they own three different things. They own Microsoft, Apple, Nvidia, Google, all about 3 times, because all 3 funds have massive overlap in their top holdings. They paid 3 sets of management fees and created the administrative joy of 3 separate accounts in exchange for exactly 0 additional diversification. Before buying a new fund, check what it actually holds. Most platforms let you look under the bonnet. If the top 10 holdings are the same as something you already own, you're probably just duplicating rather than diversifying. Right, so what does a properly diversified portfolio actually look like for a normal person who isn't a professional fund manager and doesn't want to spend their evenings staring at an asset allocation spreadsheet? And I say this as someone who has embarrassingly spent evenings staring at an asset allocation spreadsheet. The good news is that it doesn't have to be complicated. In fact, the simpler the better. Here are the 3 practical approaches in order of increasing complexity. Option 1, the one fund approach. Buy a single global equity index fund, something like the Vanguard FTSE All World or an MSCI World Tracker. One fund, thousands of companies, dozens of countries, done. This is genuinely a legitimate and sensible long-term strategy. Option 2, the 2 fund approach. A global equity index fund plus a bond index fund. The split between the 2 depends on your risk profile, which we covered in the investor types video, link in the description. Younger and higher risk tolerance, maybe 80% equities, 20% bonds, closer to retirement and wanting stability, maybe 60-40 or 50-50. This gives you growth from the equities and a bit of cushion from the bonds when markets go wobbly. Option 3, the slightly more involved approach. Global equities, bonds, maybe some property via a REIT, and a small allocation to alternatives if you want it. This is where you start building something that looks a bit more like a proper multi-asset portfolio. Still not complicated, still achievable with 3 or 4 funds, but it does not require you to think about rebalancing periodically. Check the allocations haven't drifted too far from where you want them, because one part of the portfolio has grown faster than the other. Whichever approach you go with, the important thing is that you understand what you own and why. Diversification is not about buying random things and hoping for the best. It's about intentionally spreading your risk across assets that behave differently, so that the bad days of one are cushioned by the better days of another. Diversification, the only free lunch in investing, which is how it's often described by people who study this stuff. And I think that's a pretty good way of putting it. You don't have to take on more risk to get a better risk-adjusted outcome. You just have to spread the risk intelligently. Don't put everything in one company. Don't put everything in one sector. Don't put everything in one country. And don't convince yourself that owning 10 correlated things is the same as owning 10 different things. It's really not. Ask the person who diversified their crypto across 15 different coins in 2022. If you want to work out what the right asset allocation actually looks for your specific situation, your age, your risk tolerance, your timeline, go take the free risk profile quiz at financiallyfitmillennial.com. It takes about 2 minutes and it'll give you a proper starting framework rather than just guessing. Link in the description. Drop a comment below telling me how you're currently diversified or not. No judgment. We've all been there. And subscribe if you haven't already. All right, legends. See you in the next one.